Hi all. Today I'll be covering about option trading. This particular session is for the people who don't know anything about option trading, how to start and what are the terminologies used in the option market to explain it. Not for the people who know about option market who have the advanced features. So, as I explained in the previous session, I'll just go back with a very brief information what I said. In BSC, we have only delivery trading is allowed, and in NSC, we have equity delivery trading, currency futures and option is allowed, and MCX where commodity futures and options is allowed. And trading hours is Monday to Friday, apart from the public holidays, and the equity delivery trading is from 9:15 a.m. to 3:30 p.m. and currency trading from 9 a.m. to 5 o'clock p.m. wherein only futures options allowed. Commodity trading the 9 a.m. to 11:30 p.m. where come futures and options trading only allowed kind of. Next. There are a couple of types of trading is there. One is delivery trading. That is buy a stock, keep it in your account for some days, and then you sell it whenever you feel comfortable. Margin trading is something like it's for the intraday purpose. You buy it and you have to book it for the same day. Cover trade is they will give you some additional leverage to buy more shares kind of a thing. Futures is option is a derivative stock market, which I'll be talking about in detail today. T+1 settlement is what the futures is option is happens. Okay, there are two types of futures and options are there. The weekly expiry options of futures and options is there. Monthly futures and options are there. So these two generally expires on Thursdays. If it is equities, if it is currency, it get expired on the Wednesday or Friday, depending on the expiry date which is given in the contract. What is a contract? All those things I'll just show you in the next coming slides kind of a thing. In the same way, currency you are seeing every Friday is what the expiry date. Commodity, which is having a international market relationship. So crude oil expiry date is generally comes between 15th to 19th of every month. Natural gas, gold, silver, copper, all these expense happens on the month end. Now, with respect to futures and options, these are the two derivative instruments which is available in the market. These derivatives contract can be, you can buy as well as sell. For example, in delivery, what happens is, suppose you want to buy a share, then only you can sell it. If you are not bought that share, you can't sell it. You can do it in intraday trading, those things. Not in the, if you don't have it in delivery, you cannot sell it as usual kind of. And then which are the stocks which are in the FNO market is based upon the number of turnovers, capital, all these things. Some calculation is given by the exchange. They identify those stocks. As of now, I'm seeing something like 265 stocks are available for FNO option. In FNO option, there are apart from futures, we have future is let us assume the stock price is 100 rupees spot price. Then the future price, it could be running around 101 or it could be running at the 199 rupees depending on the demand supply management. In the same lines, we have an option market. That is call option, we call it, and a put option. Call means bullish. If the stock is going up, then we take, if the call is if the strike price, let us assume from 100 to 105 it moves, just for an example I'm taking, we call it as a bullish. If a stock moves from 100 to 95, we call it as a bearish. So that is a put option. The first one is a call option we call. So these are the two terminologies which is used in the market. See, if you go to NSE exchange, if you open any particular future option stock and open the option chain, this is how it depicts kind of a thing. See here, I can share you. The main thing is the strike rate. What is a strike rate? Just assume that 300 and just to give you an example here, there is a color change you can notice here, 380, where there is a little bit. So the spot price of the stock is somewhere around 380, which is there, which is crossed to 380 to 382 is there. That is what it is. That is a strike rate. So based on some calculation, they make it at 380, 377, 375, 72, like that strike rates they made. In the same line, you can see 382, 80. So it's a bullish and a bearish. Both the sides strike rates are available. Open interest. Open interest is number of contract which is open. Number of people who bought it, they are not booked it, they're keeping it in their account kind of a thing. They're waiting for the expiry day. Expiry day is a month end Thursday, which I explained you. Change in open interest is number of people who bought it today and booked it for the day kind of a thing. And volume, how much is the volume as created? IV, intrinsic value. It is if the intrinsic value, if the spot price is, let us assume 385, intrinsic value is very high, the premium will be super high. If the premium is has to be low, means IV should be less kind. LTP is the strike price. Assume that you have bought a 372 call. The strike rate is showing around 11. 375 call is quoting somewhere around 9. In the same line, you can see on the right hand side puts 372 call. The LTP is quoting at somewhere around 8.5. Can you notice, observe the change? See, here is 11 rupees. Here it is the somewhere around 9.5. So like this, the changes happens. Bid quantity, bid, these are the standard things. Number of people who are bidding, who are all selling, what is the person is asking to sell. So these are the two types of products. That is call option, put option. Both will be available. You can see it. See, here is, I'll just explain you how the premiums, that is what I explained. Assume the strike rate is, spot price is somewhere around 100. Then the premium, just for an example I'm taking, it will be at 6. If the spot price, at that time, the premium of the put option will be somewhere around 5. The premium of the 90th put option is somewhere around 3. 85's put option is at 3 will be there, like this. You start reducing it. In the same way, call options 105 premium will be 5, 4, 3, 2, 1. These are the bottom, whatever you're seeing, 105, 110, 150, 120, 125 are the strike rates. These are the premium values, how it's going to be. Assume for a minute, the spot value moves to 105. Immediately, the premium will changes to 6 here for the 105. So you'll be gaining of 1 rupee kind of a thing. And similarly, the strike rates will change. Assume that the spot value will move to 95. Then the put value will rise to 6 at the 95 spot. In the 90s, put value will change to 5. So like this, the premium value start changing as the spot value moves. This is just an example. This is not the exact numbers. Each stock will have its own premium, its own intrinsic value. See, here you can see ITC spot price, which I was telling. This like a baseline. And the future price, you can see it here itself. This is 380 is what spot is running. Future price is running at 375. There is no hard and fast rule. It should run at the future price at 385 or something like that. It depends on the demand supply management. This runs kind of. And apart from this, the other things are, these are the people who are selling at what are different prices. I'm showing it here. Then you can see the volume as another thing, and the expiry date, when this particular contract will get expired. That is 22nd of February is the expiry date which is given here. And what is the spot price of the future, which we are showing it here. This is another one example. I'm just showing it to you. If you have not seen that, you can observe it in the system. In the same line, see, I told you about strike rates. So you can see the February 380 strike rate is quoting somewhere around 7 rupees 75 paisa, and so February ITC 380 put is quoting at 12 rupees 90 paisa. See, there is no hard and fast rule. This is all based on the calculation. These values comes out. Afterwards, once people start trading, depends on the demand supply management, these values will change. See, in the same lines for the strike rate, for example, this is a strike rate. ITC February contract 380 CE call option. CE means call option. Okay. These are the different premiums, buyers and sellers, bidders are there. And this is the expiry date. This is a spot value, what I'm showing. This is about the option market. Just see that once. If you can understand and post me some of the questions, if you whatever you are not understood, I'll try to make it across. Thank you.